Okay, let's bring in Chris Robinson. Let's bring in Managing Director of TGM Institutional Services here to help us take a look at the data. Well, let's just begin with how, Chris, we've been talking about one of the pillars of strength here, right? Fed Chair Jerome Powell addressed the labor conditions here in the U.S. And quite frankly, he said, I don't see cracks in the labor market here. And as you look at the jobless claims on a weekly basis, we're not seeing any here either.
Right. And even the last couple of times when they've tried to revise the numbers lower, the market has looked at that and shrugged it off. So I think that is, regardless of what I think the line may be, I think the one thing they've consistently looked at, this has always been about what's going on with the unemployment number, what can they do with rates as long as it doesn't put a whole bunch of people out of work. And thankfully, and you and I both were, taught that if the 2-year does what it does against the 10-year for as long as it has, we should be in recession. And, this will probably be studied by, our kids and grandkids in economics. Why didn't that happen? Why didn't we have a big, why didn't the Grim Reaper come through and put a bunch of people out of work? That has not happened. And so the reasons why for that hasn't, it's way above my pay grade. And again, we always come back to it. What matters is what the market thinks and what the market's doing. From a rational perspective, it makes it makes you scratch your head. If you look at the action that the Dow has had, just take it from the low of the pandemic, we're up 120%. If you take it from October 2 years ago, we're up 40%. Yeah. If you take it from the last 5 months, if you take it up from the last 5 months, we're up 24%. Yeah. So that's all that matters. The proof's in the pudding, and regardless of what you think about the Fed, they have dodged a bullet. They have done a good job, and if their metric really is to have avoided a lot of middle class people being on unemployment, they have succeeded.
The longest inversion in history, and again, to that point here, I feel like that inverted yield curve predicting a recession. I kind of remember jokes about it predicting 6 out of the last 4 or 3, something like that, right? So it's not necessarily the most reliable indicator, that's for sure. But let's talk about sustainability, because when you have this kind of a move up, right, you continue to look for catalysts to continue or to provide that next lift here. But optimism bound here, but at some point, you've got to start to think about buying some insurance.
You're right. That's the big joke. That's the meme out there. Your puts with the Fed chairman with your puts. It's like everything else. I've seen it in a lot of different markets. I work with, actually, I'm fortunate enough to work with a lot of farmers and ranchers, and it's human nature. When you've had a huge rally, and if you've been diligent and you've bought your puts as protection, which is really what it's the single easiest thing to do. If you've got a huge long position in the S&P, buy yourself an S&P put. It's your sell stop that you have a choice whether or not you want to execute. Those have not worked, which means they have not paid off. I would argue that they have worked, because if you're long the S&P, if you're long the stock market, you want to be, like Warren Buffett. You want to own it forever and not get in and get out. So owning those puts allows you to sit tight.
Yeah, sleep at night.
Sooner or later. Yeah. Sooner or later, we're going to have a correction. I don't know when. And what happens is people won't buy the puts when they don't need them. If we have a 10 or 20 or 30% pullback, then people come in and buy the puts. So that's just human nature. It happens in all markets. It's probably going to happen in this one, but and I think that I'll be the first one to admit that this has been an amazing rally, and what is it going to end? I don't know. There's been a lot of money lost by people stepping in front of this train trying to sell it.
That's for sure. We know what fuels this market to the upside, not only shorts having to cover, but new longs wanting to get into this. Yes. And not a lot of sellers at upper levels here. Ultimately, that drives prices higher. And I'm reminded of an old timer back in the day when I first got started out on the trading floor, who used to tell me, sell when you can, right? Not when you have to. Right. And also used to talk about how there's no shame in taking profits on the way up, right? If you're in it, as you mentioned here, for that longer haul, upside momentum here, you do want to see those puts expiring worthless ultimately. Yes. Because you want to see that bigger position working out for you, not that hedge. Moving on from the data and some of the price activity we're seeing here today, talk to me a little bit about currencies and treasuries. A busy week for central bankers. We started off the show talking talking about some of the policy decisions. It's not just the Fed, right? A cut from the Swiss National Bank. You've got the Bank of England leaving rates unchanged today. We'll hear from the RBA, was it this week as well? We heard from them, and we're going to get the Bank of Mexico later on today. So talk to me here. Really, what stands out of all of these policy decisions this week for you, Chris?
Well, it seems to me that if there is a mass text among central bankers, the decision is sit tight or cut, except for Japan. That's been the story, and that yen, the yen is still near multi-decade lows. That may be something that speculators may want to look at. What's going to happen with the yen? And as far as the dollar, I was amazed yesterday. The dollar really held up pretty well. We did not have a big kaboom in the dollar either.
Yeah, big washout. Yeah.
And I've talked about this before. Sometimes people's eyes glaze over about the technicals. I get it, but if there's a wedge there, if the dollar is stuck in this, it's moving towards the apex, but it's 104 versus 101. We're waiting for the breakout. I think a lot of people thought that if the Fed had been more hawkish, we would have gone higher, right? But I think, like I said, and with the data this morning. And that's probably my least favorite expression right now, data dependent. We're back to hearing that, right? You're gonna hear that ad nauseum, data dependent. But for now, and then the one piece of data that seems to matter the most is the unemployment report. So we're gonna kick the can. It's March 21st. In what 10, 12 days, first Friday of the month, we're gonna get a new employment number, and we will probably reprice off of that. But I think that's what I would be watching. That seems to be they may say it's all about 2% versus 3%, but I really think that, especially in an election year, that the unemployment metric is what matters.
Yeah, you've got a few things contributing to this rally, I feel like here. One, the election year, right? We know historically this is a very bullish time of year cyclically. Also, you mentioned the U.S. dollar, right, which has been relatively contained. We've been keeping a close eye on that. We've got hanging out right around 103, the middle of the range that we established last year, and a very level-headed approach towards all of this. I feel like earlier in the week, we were talking about the gains in the U.S. dollar being capped off by the yen and the rate hike there from the Bank of Japan. But today, and you mentioned the losses yesterday, I feel like those were somewhat supported by some of the weakness in the Swiss franc, the British pound, and some of the other currencies, right? So you have this sort of interesting dynamic, this tug of war right now, and the dollar, again, kind of ending up smack dab in the middle thereof here. So, Chris, talk to me about yields. We were briefly mentioning the curve here, but you've got the 10-year comfortably hanging out at 4.24%. Fed Chair Jerome Powell was pretty confident yesterday that we've seen peak.
Well, that's like the Sports Illustrated curse, right? That's it. Victory. That's the only thing that worries me. I still think that the only number that really matters for the 10-year is if we ever go back to 5%. That'll scare everybody, and we'll reprice there. But the 10-year is at 4.2. The 2-year is at 4.6 roughly, and those seem to be holding steady, which, given the last 6-8 months that we've had with the bond market, it's probably a good chance for everybody to take a breather. We'll see. We're going to get existing home sales, I believe, or the home sales number. We'll see if that impacts people, because I think there are a lot of people out there that maybe it's going to be a bigger stretch than it was 2 years ago, obviously with rates and housing prices. But they may say, okay, if the rates are going to sit here, we'll go ahead and bite the bullet and maybe try and buy a home. I'm really curious to see how that plays out. I think that's a pretty good indicator for the overall, not only the health of the economy, but just people's psyche. A lot of this is confidence based, and if people have confidence, I think they'll be more apt to go ahead and say, all right, take a big breather. We're not going to ever get a 3% mortgage again, but maybe we can deal with something here around 6.
Couldn't agree with that more, Chris. Confidence comes from credibility, right? The Fed seems to be gaining some at this point. And I'm reminded of the housing data earlier in this week. Housing starts, building permits coming in a bit stronger than expected, while the MBA mortgage apps were lower across the board yesterday. Maybe not too much to read into there, but definitely something to watch if we continue to see yields hold at these levels. And to your point here, they seem pretty comfortable here right now. The 10-year just below 4.25% here. Chris, appreciate you joining us. Chris Robinson joining us from TJM Institutional Services.